Now, for those of you, when you hear debt, I want you to think about how we raise money to pay that interest. And what the country does, what the government does, is we sell bonds. And right now, our largest benefactor is China. And, guess what? They no longer want to buy our debt because many countries are concerned that we will not be able to repay the debt. That basically what we will do is continue to print money. And, of course, when you print money to repay debt, then the value of the dollar becomes smaller and smaller. So, we're running into a crisis situation here in terms of how we're going to pay $1 billion a day in interest just to service our debt. Now, we're not talking about paying down the principal, just straight up interest payments. And of course, as you saw in the previous chart, income is flat over the last 10 years, and we've enjoyed extremely low interest rates. And we've enjoyed those low rates for some time now. And we must understand that eventually rates must increase. And that's going to be a bitter pill to swallow for many. But as rates increase, this will also eventually lead to an increased cost of living. Now, if income is flat and the cost of living starts to rise, I think you can imagine some of the challenges that we may be faced with in the future. So when it's all said and done, you've got to ask yourself, how will the government pay for the challenges ahead? And are you prepared for what's ahead? Next slide, Mark. So back to history again. Well, the last time we saw a situation where the debt was just totally out of control was back during World War II. After World War II, to pay for the rising debt that the country accumulated, if you look at where it says peak 94%, right after World War II, the highest marginal tax bracket was 94%. And we saw that increase in marginal tax rates because it was required to pay down the debt. Now, I'm not saying that, we can expect tax rates to go to that extreme. But if you look at the current tax rate of 35%, we're basically in the lowest tax bracket since the Great Depression. As a matter of fact, I think many of you can recall when Ronald Reagan was president, the highest marginal tax bracket was 70%. So that's a major challenge, is that the government will need to find ways to increase taxes. And you and I, as investors, we need to be mindful of the fact that so many people have 401k plans where those taxes have been deferred. And when you need the money to create spendable income, you've got to ask yourself, do you think taxes will be lower or higher? So that's a major challenge, and one that I would basically ask everyone on the call tonight to seriously consider. And I think you will come to the same conclusion that I've come to. The government has no choice but to increase taxes. Next chart, Mark.
And Tony, before you go there, let me just speak to what you just shared so that you can put it in context with what you just spoke about with 10,000 seniors. I want everybody to understand this because I know that a lot of people that are on this call tonight are not senior citizens. So understand that if for the next 20 years, 10,000 seniors are going to come onto are going to turn 65, that you need to find a way to get the capital from that group. The government is going to look for a way to get the capital from that group because that group is going to be the biggest drag on the economy because of entitlements. So when taxes go up, taxes don't just go up on a particular age group. Taxes go up across the board, and 65 to 70% of all the wealth in this country is actually owned by that group. It is those baby boomers. It is those over 65 that have all of the money. So as they are going after that group and they're going after their tax dollars, you will get caught up and swept up in that tidal wave of taxation.